Hello and welcome. This training will teach you how to grow and protect your wealth and become your own bank by using the Fortify asset. Introduction to the Fortify asset. So number one, it's embedded in American history. It's an asset that's been used by the wealthy for generations. Number two, it annihilates the curse of generational poverty. When it's set up correctly, it replenishes with every new generation instead of withering away. And three, there are success examples in American history, such as Ray Kroc that used it to start McDonald's, and James Cash Penney used it to keep J.C. Penney out of bankruptcy. The four core benefits and features are: number one, it's categorized as a tier one asset by banking regulators. It's the safest and most liquid of all assets. Number two, it's SBIC insured for up to $500,000 instead of FDIC insured of up to $250,000 like your checking or savings account. Number three, it allows you to grow your money and experience market upside without market downside. And number four, it protects your family from poverty, catastrophic medical bills, market loss, bankruptcy, creditors, and lawsuits. So Chris, really, what is it? It is an overfunded life insurance contract that is indexed to market performance, also known as an indexed universal life policy. Fortify is an acronym. It stands for flexible premiums, optimized returns, retirement planning, tax advantage, indexed growth, financial security, and yield. We're going to dive into what each letter means and what are the implications. Hi, I'm Chris Manitius, and I'm going to tell you my story of why a $300K per year consulting executive became a life insurance agent. Quick background on me. I went to Hollywood at 22 to become an actor. I got a few roles, including one on The Young and the Restless, and I got tired of waiting tables, so I started a photo booth business because I saw one at a party and I found out how much it rented for. That became pigstation.com. In 2019, I actually scaled it to 100K in revenue in a single month, running it from my apartment. But then the pandemic of 2020 happened, and it basically collapsed my business overnight. All my events canceled. It was a really, really tough time for me. So I had to pivot my career into something else. So I got into doing sales for online coaching businesses because I figured in a pandemic, online entrepreneurs would be safe, tucked away in their house, so I could just sell their programs. And I did very well doing that. I started making 20 to 25K per month within months of changing careers. Completely changed my life. I was able to buy my dream house just 2 years later of completely restarting my career. And my career progression was pretty good. I became the VP of sales and enterprise sales for a top sales training company. I had 30 sales reps I was responsible for. I got to experience overrides, and I scaled my income to $30,000 to $40,000 a month. So life was good. 2021 was actually my introduction to financial services. This was at my previous job. The CEO of the company I was working for did a Monday morning training on investing. He went over a maximum funded whole life insurance policy and how you can become your own bank. And I thought that sounded pretty good since my wife and I wanted to start a family. So I Googled whole life agent. I found one near me, and I set up a policy for myself and for my wife. It wasn't until 2023 when I compared my whole life to an IUL. And I realized when I was looking at them side by side that the IUL would blow my whole life out of the water. The premiums were more flexible, the gains were much higher, and the lending options were more appealing. I never had to pay back loans in an IUL. And I realized that had I known this information earlier, I would have made a different decision and I would have saved a bunch of money. So I switched to an IUL, and I even started one for my daughter. Now our whole family was protected. So I actually decided to get my license at that point. I felt a calling to teach others this information so they could be blessed by the power of a flexible permanent life insurance policy and by the power of financial education. I left my corporate sales job to dedicate my time to teaching people these financial concepts and helping other motivated self-starters get into financial services. I desired being my own boss again, and I wanted to make a massive impact on the world. I am attracted to contrarian ideas, but I don't like taking a lot of risk. I figured there were a lot of people like me out there that I could help. So what is an IUL? It's an indexed universal life insurance policy, and that's a kind of permanent life insurance that offers the potential for cash value growth based on the performance of a stock market index. Whole life, on the other hand, it pays dividends based on the performance of the underlying insurance company. How does an IUL work? Well, step one, you pay the premium. Step two, a portion goes towards policy charges, such as the actual life insurance. And step three, the remaining funds get allocated to index strategies of your choosing so the life insurance company can grow your money for you and reduce their own net risk. Key takeaway, the more life insurance companies grow your money for you, the less at risk they are. They are motivated to give you returns out of their own self-interest. Why should you care? Well, number one, families who don't have life insurance where the breadwinner dies are at risk for slipping into poverty. And number two, life insurance is the only vehicle in the IRS tax code that allows you to grow money tax-free, access it while you're alive tax-free, and pass it on tax-free. Relevant tax codes are 72E, which allows for tax-free growth, 7702 DEFRA, tax-free access to your money, and 101A, tax-free death benefit. Why should you care continued? Well, they also allow you to experience all the upside of the market without all the downside. This is because IULs are indexed. They have a floor of 0%, so when the market goes down, you do not lose money in the market. On the right-hand side here, that's an indexed account. You get to lock in your gains. IULs have indexed accounts, so do fixed index annuities. Those are self-funded pensions I also help my clients with that lock in their gains. Most people are in variable accounts like stock market, crypto, and you can make a lot of money, but you can lose a lot of money. So indexed accounts are a powerful hedge. What's the catch? Well, sometimes IUL companies will limit your upside, but not always. The IUL companies I help my clients with, they actually have uncapped growth strategies. And insurance companies make plenty of profit from the fees within life insurance, on people who never end up dying during the term. And sometimes they keep a small portion of the upside movement of your money. Are IUL safe? Extremely. They are SPIC insured up to $500,000, which is twice the protection of FDIC insurance on checking and savings accounts. Plus, insurance companies are the safest companies in the world. They have weathered almost every economic downturn, including the Great Depression, and they've done this better than any other industry in the world. If IULs are structured and funded correctly, they are incredible vehicles for wealth accumulation and preservation. How do I know if an IUL is structured correctly? Well, it's pretty simple. Number one, work with a good agent. Number two, just make sure the agent gives you life insurance that's proportionate to how much premium you want to put in. It's called minimum non-MEC. Sometimes they have to give you more life insurance if you want to put more money in later, so it's not always about bare minimums. And number three, you want to make sure your death benefit is level when you stop putting money in to stabilize your costs. What are the main key benefits of an IUL? Number one, death benefit to your family. Two, living benefits. Some IULs insure against cancer, heart attack, stroke, accidents, loss of income, and more. If most people get these things, why not pass the risk to an insurance company? Three, cash accumulation without market risk. You get to lock in your gains. Four, you can access your money for anything and pass it on to your loved ones completely tax-free. And five, tax-free retirement income. Yes, tax-free. When you take policy loans, it's tax-free. That is in the contract they give you in your IUL. Want my help? If you want to sit down for a free consultation and look at all your options to protect your money and protect your family, click the link below this video. So this is an overview of flexible premiums. Unlike whole life insurance, premiums can be increased or decreased and can change based on life changes or needs. And if you are making more money, you can actually max fund the policy to maximize cash value gains and overall efficiency of the policy. And if your income drops, you can actually drop the premium to the minimums of the policy to keep the lights on and prevent the policy from lapsing. This can create enormous peace of mind to a lifelong commitment. So this is an example of how adjustable premium options work. So in this policy, this person can put in up to $27,000 per year or $2,300 a month into this plan, and he can drop the premiums all the way to $2,700 per year or $230 per month. So again, the delta is $230 a month all the way up to $2,300 per month. So you can see that these policies give an enormous amount of flexibility to be able to increase or decrease premiums depending on life changes. So here's a couple of strategies for optimizing flexible premiums. So the most important thing is you want to fund the policy to the maximum allowable level if you can swing it. If you can't, just overfunding as much as possible is best practice. Overfund by adding more premium than the target premium. So you can always find the target premium on your policy. You just want to make sure you're adding more than that. Then you're in the green zone. And this makes the policy more efficient and the ratio of cost to cash value growth optimizes. It's like filling your gas tank up to the top, which results in your car getting better gas mileage than if you just drip in some gas, okay? So you can only fund the policy based on how much life insurance you have. So if you have a larger policy, you can stuff more premium into it. If you have a smaller death benefit, you can put less premium into it. You know, if you send too much money to the life insurance company for your policy, the life insurance company will ask you if you want to break the contract. Just don't break the contract. Do not break it. They'll just send you the excess money back so you can stay within IRS guidelines. So it's no big deal. But if you break the contract, the life insurance contract will become a modified endowment contract and will lose its tax-free status. So you don't want that, but it's easy to avoid. O stands for optimize returns. So in order to explain how that works, I have to explain the three ways money grows and the only three ways that money grows. So the first way is fixed growth. That's flat line growth. Think 1 to 4% per year, like your checking or your savings account. And number two, there's variable growth, which gives you unlimited upside, but you have downside market risk. There's no principal protection. Think stocks, think crypto, 401k. And then there is indexed growth, which has a 0% floor. You get upside exposure, so you can grow your money, but you don't get downside market risk. This is the chassis underneath an IUL. This is what's behind optimizing returns. So just to give you an example of how it works, this is a variable account versus a indexed capped account. Okay, now the variable account is uncapped, okay, but it can experience market losses. The indexed account is capped, so the gains are capped, and you can see here which one ends up in a better position. So on the left side, you have mutual funds, IRAs, 401ks, both starting with a $100,000 balance. Now here, with 3 loss years back in the early 2000s, the $100,000 would have gone down to $59,000. Then it would have climbed back up to $61,000 in 08. Well, actually $99,000 in 07, but then it dropped to $61,000 in 08. Then the market had a pretty good incline all the way up to $170,000 in 2018. Well, actually, that was a 6% drop there. 3 positive years, then a negative 20% year, ending at 2023 with $281,000. Okay. Now, if we compare that to an index universal life policy that grows anywhere from 0 to 12%, but no loss years, if you started with that 100,000 and didn't experience the losses, you'd actually end up with 474,000. So would you rather end up with 474,000 or 281,000? Now, just to be fair, what is not factored in here is costs inside an IUL, because there are policy fees. So that 474,000 wouldn't be that. But it still would grow nicely compared to a variable account where you are experiencing those loss years, which cause you to lose time. And if those aren't properly timed, it could be really bad for your retirement. So this is how you can optimize returns. R stands for retirement planning. Number one, you have a tax-free retirement income stream that you can actually take out of an IUL. Your Fortify asset can provide you that tax-free retirement income stream that will exceed your IRAs. And number two, you get a tax-free generational legacy. When you die, a lump sum gets transferred to your heirs completely tax-free. So in this graphic here on the left, if you had a 401k with a $1.481 million balance at 65 years old with a 30-year payout, this would produce at the very bottom here, after taxes, $48,000 per year. Okay. Now let me explain this. So 1.4 million, we're moving into 2% investment return rate, because when you start to take money out of a 401k, you got to keep it safe. Typically people put it in cash and bonds. A 30-year payout with a 25% income tax rate, that's how we arrive at an annual payout of 64,000 minus out taxes, 48,000 is what you're left with a $1.4 million balance. Okay. Not a lot for having that much money, right? Now, if you look at the same exact balance in an IUL, so $1.481 million balance, that actually produces $92,000 per year tax-free income. So not only is the income almost double, but it's entirely tax-free. Now, the reason for this is that the IUL actually has money working for you while you borrow the insurance company's money as the income. So you're using the same dollar twice. This mechanism is impossible inside of a 401k because you are depleting principal every time you take money out. This is why you can very easily run out of money in your 401k while your IUL can continue to print money for the rest of your life and then leave something for your family when you're gone. So would you rather have a post-tax income of $48,000 per year or $92,000 tax-free? That's what's possible with an IUL. T stands for tax advantaged. So number one, you can grow your money tax-free. All your gains in an IUL policy are tax-free as long as you stick to the funding guidelines of the policy design. Okay, this is in the IRS tax code, IRC 72E TEFRA. That allows for tax-free growth. Number two, you can pass on your money tax-free. When you pass away, your relatives will get a tax-free death benefit according to IRC 101A. Okay. And number three, you get tax-free access to your money for any reason. Unlike your 401k, you can pull money out for any reason. This is IRC tax code 7702 DEFRA. I stands for index growth. This will be a quick one because we talked about this already. But so once again, index growth allows participation in the market performance while providing downside protection, eliminating the risk of market loss. And this allows for capital preservation. It focuses on preserving capital while ensuring opportunities for growth, offering a balance between security and investment growth potential. F stands for financial security. So an overview of this is that insurance companies have weathered every single economic down cycle better than any other industry. Life insurance policies are considered a tier one asset, meaning they are the safest and most liquid assets. Banks actually own billions of dollars of life insurance. It's called BOLI. A book I recommend you check out is Money, Wealth, Life Insurance. And in that book, and you can even look this up online, you'll find that Bank of America has 24 billion in cash value in life insurance. Wells Fargo has 19 billion. JP Morgan has 12 billion. PNC 10 billion. Truist Bank has 7 billion in cash value. Okay, that's the source of where I found those figures. And you can get $500,000 in SPIC coverage on your policy versus $250,000 in FDIC coverage in your checking account. That is twice the security. Not only that, but every insurance company has reinsurance. They insure each other. It is the safest place to hold your money in the entire world. Y stands for yield. And to explain this, I've actually included some redacted real statements from IUL policy. So this is a policy from Nationwide. The beginning cash value was $102,919. These were the net premiums paid, and indexed interest strategies interest credited is this highlighted amount. It's $8,900 roughly in 1 year. So on $102,000 in cash value, this policy experienced a $8,900 gain. Okay. And it's a point-to-point gain. And what that means is it's not like you're going to see an up and down every day like the stock market. It's after 12 or 13 months, you get a statement, an annual statement, and they will tell you what they credited to your account. So, and the gains can be larger. Like this is another redacted statement, but this policy had 1.2 million in it. 1 year, there was a 61% gain. As you can see here, the segment interest rate. And then there's a performance factor here, which is a multiplier on gains. This one had a 2.49 multiplier. So his total gain, basically you take the segment performance factor. It's also called the participation rate, and you multiply that by the segment interest rate, indexed interest rate. And that's what you get as the total gain. So 1.8 million was credited to this guy's policy or gal. So the policy value went from 1.2 million to 3 million at the end of the year. Would you guys be pretty happy with that? I'm guessing you probably would. So that's how the yield shows up on a statement. And this is how the yield actually works. So like I had mentioned, it's point to point, so you're not going to see ups and downs like the stock market. And what they do is they, let's say you have $1 million in your cash value. They're going to keep most of it, like let's say $960,000 in a general account portfolio where it's safe, in boring stuff like bonds or, low risk investments. And they know that the value will go back up to that $1 million. So that's how they can guarantee you that 0% floor. And what they're going to do is they're going to take a small percentage of your cash value, in this example, 40,000, they're going to put it in options. Okay. So life insurance companies are the biggest buyers of options in the world. And then when that option hits, you'll get a gain. And if it does not hit, you will not experience loss. That is how it works. It's a pretty mind-blowing mechanism when you think about how clever it is. Money managers at insurance companies are some of the best in the world. Insurance companies are incredible at managing risk. So take advantage. A common question I get is how can IUL policies guarantee a 0% floor so you never lose any principal? And so I actually have this diagram that will help explain how indexing works, meaning how is it that they can guarantee 0% floor? So let's say that you have $1 million in your cash value policy, okay? So, and what they're going to do is most of it is going to go in here, which is it's called the general account portfolio. Okay. So your money is just like sitting in low risk, boring stuff, typically bonds that go up like 4% per year. Like they know that. Okay. Now, if you notice here, there's only 4% missing here. Okay. So they know over the course of the year that your money is going to go all the way back up to your original cash value. Okay. Now, with the extra 40K, they're putting that in options. Okay. So if they grow the 40K to 120K, you are going to get about a 12% increase, which more or less mirrors the market typically. Okay. So they are going to credit your account 120K that year. Okay. And this is all while your underlying principal is safe and not in the stock market. It's just mirroring it. What to do when you want to stop paying into the policy. So when it comes to life insurance policies, it's important to understand that when you stop making premium payments, you just want to make sure your policy is properly set up. So this is exactly what you need to know. So basically, when you want to stop funding premiums into your IUL, maybe you're later in life or you've paid in significantly and you want to stop funding premiums, or maybe you want to start taking income, you just want to stabilize the death benefit. So before I get into why, let's quickly discuss the two different types of death benefit inside an IUL. So there's either going to be a level death benefit or an increasing death benefit. Level death benefit is a stable death benefit that does not change. So let's say your death benefit is $650,000. It would stay that way for the rest of your life. You can't always change it. So if it's level, it'll stay that way, but you can call the insurance company to change it if you want to. So that just means that your family would get the cash value or the death benefit, whichever is greater. It's better for stabilizing costs. It's a better death benefit for older people. Um, and then the other kind is a increasing death benefit. So an increasing death benefit means that the death benefit increases as you fund the policy. So this can be good for putting more money into the policy. It's good for 30 and 40-year-olds. And so if your policy was set up in your 30s and 40s and later in life you want to start taking income, you just want to make sure that you call the insurance company and just make sure that your death benefit is level so you stabilize costs, because you don't want your death benefit to continue to increase as you're taking money out of the policy. And some companies even automatically switch it to level when you start taking income out. So it's not a huge deal. It's just something to be aware of. Basically, the bottom line is if you want to stop paying into the policy or start taking income out, just make sure the death benefit's level. Not a huge deal, just something to be aware of. Now, the next topic we'll cover is understanding policy loans. So there's different loan types with different insurers, but they essentially fall into three categories. The first category is a standard loan. So a standard loan allows you to borrow from the policy's cash value with a set interest rate and the option to repay the loan. This can be useful for funding investments or supplementing retirement income. The second category is a participating loan. A participating loan offers variable interest rates tied to the performance of the policy's underlying investments. This can potentially offset the loan interest, effectively allowing you to earn money on the borrowed funds. So for example, if you have a participating loan, let's say the interest rate is 5%, but the money in your loan collateral account earns 8% in the index strategy, after minusing out the 5%, which is the charge for your loan, you would have earned effectively 3% on your borrowed money. So you just made money on your borrowed money. So this is a really cool feature within IULs. And the third category is a zero wash loan. That just means that, like, if the insurance company charges you 5%, they credit you 5% at the end of the year. So your cost is effectively zero. So you can maximize policy benefits by just understanding the different loan types. So they offer you flexibility. So that's the really nice thing about IULs. There's different loan strategies within them. And you can preserve your capital with techniques like the zero wash loan, so that you stabilize costs and you can effectively borrow your own money for free. You may be wondering, why do I even have to pay an interest rate if they're just going to credit me back the interest rate? Well, it's because the IRS, for it to be a loan, there has to be an interest rate associated with that. So it's just to stay compliant. But by understanding all the different features and applications of each loan type, policyholders can strategically manage their borrowing costs and potentially enhance the overall performance of the IUL policy. So let's now briefly talk about the loan tax implications. So the number one thing is that there are tax advantages. So loans from the cash value of an IUL policy are generally not subject to income tax as long as the policy remains in force. The potential consequences are such that if the policy lapses or if it's surrendered with an outstanding loan balance, there may be tax implications that you should be aware of. And definitely consult experts. Policyholders should consult with financial and tax professionals to understand the specific tax implications of their policy loans and ensure compliance with relevant regulations. But the bottom line is, if your policy is enforced and you're borrowing against your policy, loans aren't taxable according to the IRS, so you're in the green. So loan interest considerations, there's interest calculations. You definitely want to monitor performance, and you want to optimize for costs, right? So policyholders should carefully consider the interest rates and repayment schedules associated with their policy loans. Now, a lot of policy loans don't have to be paid back. They just get reconciled with your passing, with your death benefits. So that's the really, really cool thing about IULs. But you want to keep an eye on it. Actively monitor the performance of the policy. You can call the company. They'll help you with that. They want you to keep it forever. They want you to be happy with it. At the end of the day, it's a product that a company wants you to be happy with, right? And you can optimize costs with zero wash loans and just monitoring the actual policy regularly, like I mentioned. So you want to align your loans with your financial goals. You want to assess your needs. You want to evaluate loan features, and you want to implement a strategy that makes sense. So you can talk to your financial professional who help you set up the policy. You can also talk with the insurance company. They're extremely knowledgeable. Like their customer service specialists understand these loans very well. So you can call them and just ask what the best strategy is for you. So in conclusion, like understanding the various loan types within IULs is essential for policyholders seeking to maximize the benefits of their coverage. By carefully considering factors such as the death benefit, stabilization, and loan types and tax implications, policyholders can make informed decisions that align with their long-term financial goals and objectives.